Now we come to the part of the show where I talk about what I believe is important for individual investors to consider before they make their investment decisions. And as always, we have three topics or three ideas to focus on. The first one, third quarter earnings. We just started the third quarter earnings season, and pretty much U.S. banks have been the main focus so far. Today, we will get earnings from, I believe, Netflix, Tesla after the bell. But so far, the big banks and even some of the big regional banks have reported. So that's something to focus on. We'll touch on that a little bit. U.S. government bond yields, one of the mainstays of this segment of our show. Bond yields are definitely going higher regularly, and we're starting to see the 10-year in the U.S. approach 5%. And the third topic or idea to consider, dividend stocks. How to choose dividend stocks. We all know dividend stocks are a fantastic idea. You get paid a good dividend while you wait, but is it just enough to buy stocks that are paying good dividends, or should you consider something else as well? So let's go to the first idea, which is third quarter earnings. And as I mentioned, we've heard from the big banks, whether it was the biggest banks, JP Morgan, second largest Bank of America, Citibank, Wells Fargo, etc., some of the big regionals. I think the main message is that these banks are telling us they're doing fine. A lot of these banks, with the exception of some of the reports we got, I believe, yesterday, and I think today, Morgan Stanley as well. They were a little disappointing, along with Goldman Sachs yesterday. But the other big money center banks, Cities and the Bank of America, they're doing quite fine. And in fact, in some cases, the money they're making, the net interest margin, which we've talked about in previous shows, so that's the spread between what they're charging for loans and what they're paying out to investors, is actually growing a little bit. So that's a positive thing. So let's take a look at a chart. And I think the first chart we have is one of Bank of America. And keep in mind, as I said, Bank of America reported really good earnings. But I think from some of these banks, the CEOs, the stories they're telling, the information they're giving us is probably more important than this chart itself. And if you look at the chart, you'll see Bank of America trading at a low point. Its yields are getting in that 3 to 4% range. Stock is trading down at $27, $27.50, down from back when it was trading in that $40 to $45 range. So quite a bit off. But more importantly than the chart, CEO of Bank of America, along with the CEOs of JP Morgan and Citibank, they're starting to tell us that all the savings that individuals had, I guess, built up from the pandemic times, the COVID times, and some of the government subsidies or programs, they didn't travel as much. So they had a lot of savings built up and were sitting there. A lot of those savings are now being spent, and we're seeing them dwindle away. And so savings accounts aren't as large. There's not as much money in them as there once was. So that, to me, has been the main message that I'm hearing from these banks, that savings accounts are starting to fall. The values are starting to fall, which means, according to these CEOs of these big banks, that they foresee a time when spending will significantly slow down. We haven't seen it as yet. We continue to see retail sales numbers in the U.S. especially doing extremely well. People are still spending, whether they're using cash or credit. We're seeing plastic being used a lot more these days. Whatever it is, it will start to slow down. Another chart we have here, Bank of America, one on PNC Financial, the largest regional bank in the United States. Again, this bank pays over a 5% dividend yield, so you get paid a nice dividend while you wait. And another name that I think reported pretty good earnings. Stock jumped initially into the low 120s, but has pulled back since. Another bank in the U.S., one that we all love and talk about frequently, is Citibank. Citibank, big money center bank, Citigroup, pays over a 5% dividend. Now, that's not something you see often. It's been in around 5% now for a little while, but prior to recently, the recent downturn in the stock into the low 40s, we really didn't see Citibank trade this low with such a high yield. So overall, corporate earnings season, in my opinion, has started on a good note. I heard a stat just the other day saying, even though we were still early in the early days of corporate earnings season, 92% of the companies that reported, and obviously mostly were banks, beat or exceeded expectations. So that is a good start, and hopefully the other sectors can pick up from there. The second idea that I want individual investors to consider before you make your investment decisions is this whole idea of US government bond yields. And we're watching these yields very closely because, as we know, as yields rise or interest rates rise, stock market tends to fall. Interest rate sensitive parts of the market, like technology, which make up, especially in the US, a large amount of the index, 30–40% of it, of the S&P 500, is tech. If interest rates continue to rise, tech will probably have a tough time and struggle. Other areas, such as real estate, as we know, will continue to struggle. And some other interest rate sensitive areas like utilities and other sectors. So very important to keep an eye on interest rates. And first chart we have here, the US 2-year Treasury rate. You can see it now well over 5%. I think last show it was just under 5%. And today, well over 5%. And the 10-year we have right after that, approaching 5%, 4.87. These are yields, again, US Treasury yields. These are yields we have not seen really going back all the way to 2006. Now, a couple of things to understand. Back in 2006, interest rates were at these levels, of course, but the stock market was actually doing okay, and it did all right until we got into the financial crisis in the end of 07 and into 08. But interest rates can be this high, and the stock market continued to go higher as well. I think the issue is more of the speed of these interest rates rising and the unknown. How much more will they rise? And as I've said on TV, radio, and on our show here, if we can get some certainty with regards to interest rates, I think that will be something that can give a boost to the markets. But one of the things I wanted to mention, and a question everybody's been asking, is why are interest rates so high? Why are they continuing to move higher? Some people will say it's the Fed. You know, they're raising rates has caused the short-term bonds to move higher. Some people will say it's actually the strength of the U.S. economy that has caused interest rates to move higher, as well as the U.S. dollar. But an interesting thing came up just last week. Last week, the U.S. had a Treasury bond auction, and they auctioned off 30-year bonds. Now, why do they auction off bonds? Well, we have a chart to show you why they offer, or they have auctions for bonds and try to sell bonds, and it's to cover their debt, right? The U.S. needs to cover its debt. This is an unbelievable graph, and if it's one graph that stood out to me for this show, it's this one. U.S. federal debt has now surpassed 32 trillion. Yes, trillion with a T. When you look back at where that debt level was, 15 years ago, much lower. You were looking at debt levels under 12 trillion. And here we are almost tripling of that just in the last 10, 15 years. No wonder why a lot of, government officials, senators in the U.S., a lot of Republicans, even Democrats in the U.S. continue to focus on this and complain about these high levels. So what happens is U.S. has to sell a lot of bonds to cover a lot of debt. And of course, if the demand does not meet the supply of these bonds being sold, we see bond prices fall, right? Supply increase over demand, prices will fall, yields will rise, and that's what we've seen. So last week, I believe Thursday, they auctioned off 30-year Treasury bonds in the U.S. The demand was not there for those 30-year Treasuries. Who wants a 30-year government bond when you could buy a 2-year bond, which is yielding higher than the 30-year? So the demand was not there. Bond prices fell so they could actually sell these bonds. Yields had to go higher. And again, another reason for bond yields rising, and therefore stock market fell that day. So we want to keep an eye on U.S. Treasuries, even more so than Canadian bonds. The last topic I wanted to get into, which are your dividend stocks. And everybody wants to own dividend stocks. We talk about it all the time. But do we just want to own specific dividend stocks that really don't show much growth and just pay a decent dividend? Well, the quick answer to that question is no. Those dividend stocks, I should say, are the ones that are getting hit the hardest as interest rates rise. They tend to be more interest rate sensitive when there's not much growth there. than other dividend stocks that actually have a growth component to them. So let's take a quick look at a few charts here. First one is PepsiCo. Pepsi, they reported fantastic earnings recently, taking up expectations for the full year. But as you can see here, their stock has fallen. One of the reasons, it pays only a 3% dividend. You could get a higher rate of return without any risk owning a 2-year treasury, as we just showed you, over 5%. So who would want to own PepsiCo if it's not showing much growth and you could get a better yield on your money in something that is basically with little or no risk? So a lot of people have sold PepsiCo to move their money into a treasury bond, maybe even a 2-year treasury. Next graph we have here, a chart, Fortis, a Canadian utility company, paying a little bit higher in that 4% range. But once again, who's going to want to own Fortis for the income they provide when you can own a short-term government bond that is paying higher? Looking at another name here, Rogers Communication. Again, 3.5% dividend. Rogers not showing a lot of growth, like many of the telecom stocks like BCE and TELUS. People are selling their telcos and buying short-term treasuries. The next chart I want to show you is kind of opposite of the first 3 charts I just showed you, and that's a Broadcom. Now, Broadcom had, for a while there, over a 3% dividend yield. The stock, as you can see, has run up tremendously. So now that dividend yield is about 2.25. But even though you're getting a smaller dividend, you're getting the potential for a lot more growth. And so what has happened is investors will say, you know what? I'll go into Broadcom. I'll make a couple of percent just for owning the stock, but also reap the rewards that Broadcom offers us, which is share appreciation. And we've seen a lot of that share appreciation in the last few years. And the last chart I have, a part of this segment, is a chart of Bank of Nova Scotia. I just talked to an investor this morning, and we spoke about Bank of Nova Scotia yielding as high as 7% today. Just for owning the stock, you're going to make 7% return. But I also believe you will get capital appreciation or growth out of this name as well. And that is a name I think people can own, of course, if you can handle the volatility that a name like Scotiabank brings. So owning dividend stocks just for the dividend and very little growth is just not worth it anymore. You want to own names that can pay a dividend, but it can also grow. And I think in this higher for longer interest rate environment, those are the names that are going to win over the long term.